This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. After 4 weeks with little relief from the fear pervading markets via the latest conflict in the Middle East and the disruptions to global energy supply, some semblance of order is emerging from the chaos, at least for now. As we recorded this week, volatility and longer-dated oil futures were showing the first signs of putting in a peak. Events obviously remain fluid, and that statement might prove hopelessly naive, but nevertheless, markets are calming. Most notably, global interest rate volatility looks a lot more settled. But this calm, however permanent it might or might not be, comes after significant upheaval, the effects of which still do remain in market prices. Central bank policy trajectories have shifted from a neutral or easing bias to one clearly favoring tightening. Yet forward rates, especially for inflation expectations, speak to the growth shock that is now expected to follow the initial early wave of inflation. Figuring out where we sit in all of it, how the repricing and volatility will affect credit markets, whether central banks will actually deliver against those tighter expectations, and what all of that means for the global economy are still up for considerable debate. So it's great to have Marvin Lowe, a senior rates-focused strategist from our team in Boston, to join us with his thoughts on all of those things.
Hello.
How is my brother from another mother?
You come into our time zone, and I don't even get to see you.
I know, I'm sorry about that. I figured this was the perfect week to catch up with you on rate markets to see where we are. I mean, I was in the US and Canada actually last week marketing some of the new work I'm doing on volatility, and it's rate volatility that is really in focus. I mean, you could look at equity markets and think, look at the VIX, say, this is it's a crisis, but it's not a disaster. Look at FX vol, you'd be forgiven for thinking nothing has really happened if you were looking at, say, dollar yen or euro dollar. We'll leave aside
Sure.
EM. But in rates, the MOVE index has gone from, at the beginning of this latest crisis, around 62 to close to doubling that. It's at 112 as we speak. So rate vol has basically doubled. We're in the midst of actually a violent rally, which is as violent as the sell-off that we've seen over the last few weeks. So I just wanted to ask, first of all, why has rate volatility been so much in focus? And really, as a broader question, where are we in rates at the moment?
Yeah, for sure, it's been an interesting month. What's been especially interesting is that volatility has come after a prolonged period of no volatility. So I think to a certain degree, there was a degree of coiling that was developing in the rates market. We, certainly were trading within these narrow ranges where, computers probably loved it. You kind of you bought the dip in yield, and then you sold at the upper end of it. And that really changed as we started to think through, at a minimum, the short-term inflation type of discussion. So it has been break evens at the short end that drove the start of this higher yield move in the beginning of March, but it's ebbed and flowed as all the other markets and all the other headlines around how long this was going to be, what the off ramp was, and then we started to see real yields kind of get into that discussion, that stagflation type of thing. So at this point, fixed income investors are taking a lot of this input and trying to reprice what had been amongst the most stable, quiet, and I would say boring several quarters that we had going into the beginning of this year, and even going into the middle of February. And of course, that has been, as you said, really shaken to the core a bit.
Yeah, I mean, it's a key theme that I wanted to tease out as we chat for the next 20, 30 minutes or so, which is that you have this huge front-end repricing especially, but also long-end yields going higher. You mentioned break-evens, and again, 1 year, 2 year inflation swaps are spiking higher because of what's happening in oil markets, and the notion that energy price inflation is going to contribute to headline inflation for some time is pretty obvious at this stage. But longer end break-evens, or say like 5 year forward inflation swaps, so 5 year inflation in 5 years' time, has actually been collapsing because we have the growth worries that then
Yeah.
follow every inflationary shock. And I'm wondering if you have a sense of when we might be close to markets thinking about that tipping point from worries about inflation then morphine into the ultimate worries about growth, or are we still so far away from that in your view?
No, no, no. I think we're a lot closer than what the nominal markets would show. So one of the more interesting things is if we look at the inflation markets and we take that as the best proxy for expectations around the forward path of inflation, is that most of the concern is transitory in the inflation swaps market. We've had a big repricing and kind of that 1 year type of view, but as we look at like 2 year 1 years, 3 year 1 years, they're flat to where we were before the conflict began. And then further out the curve, 5 year, 5 years in particular, as you mentioned, they're actually lower than what they were. So there is a growth concern that's developing around here. The fact that 2 year, 1 year, 3 year 1 years are stable, even though we've got as big of inflation shock in the short term, kind of pushes back against the convention that we are getting to a tipping point within the short term that growth is going to get impacted. But there absolutely is growth concerns that are building out there. And I think when we see what we've seen today, for instance, and one day certainly doesn't make a trade. I think we're going to see those growth concerns make their way into the inflation market first, and then certainly pull through all of the, if you will, micro measurements we get within kind of these rates yields.
Let's assume for a moment, though, that we are still concerned in the near term about inflation. And I want to, the central bank reaction function is ultimately where we're going to get to with this because the movements in front end yields that we've talked about have, of course, been driven by central bank expectations. And so let's run with this scenario of high energy prices for some time, the downstream effects that we can all read about, whether it's fertilizer prices or plastics, all these goods related second order effects that we're likely going to see higher prices in. Is there a yield level at which you think this becomes a tipping point, not just for the rates market, but for risk markets more broadly?
Yeah, I think if we're looking at the treasury market as kind of like, let's say the global indicator, if you will. Once we start talking about, 4 and 3/4, 10 years, getting to the 5% 10 year, you really are pulling a lot of theoretical aspects around where our star needs to be and kind of where we are much later in the business cycle relative to where we were from an economic perspective the last time we started, really being concerned with the 5% 10 year. I do think a 5% 10 year where energy prices are pulling that up really does affect a much broader aspect of the economy now than what we were concerned about a couple of years ago. So, the pushes have been violent, and I think that's really the big concern in terms of how quickly we've been able to reprice those expectations. And that in and of itself, does create kind of that growth concern. And, today growth concerns are first and foremost, but certainly the dynamic between break evens at the short end and reals at the long end remains this theme that I think we need to continue to look at.
Can you talk about the channel through which that really does affect economic output in particular? Because we've lived through the post-pandemic hiking cycle. What are the mechanics by which, say, 5% 10-year yields really start to impact the economy?
I think the corporate channel, which has been such an important metric and contributor to growth, whether it's AI growth, whether it's data center growth, that CapEx has been, a really, really big part of the growth story. And I think that winds up being probably the channel that I look at that makes its way into a jobs market, which certainly, if we're kind of looking at the jobs market the last 6 months, and I guess if you want to include revisions, really the last year, it's at a stalemate to a certain degree, but it's not like we have the degree of excess job creation that we did a couple of years ago when we were seeing these rates push up. So I think the transmission and the elasticity, if you will, of that transmission into the broader economy is much quicker just because we're so much further along in this cycle than we were, when we were last contemplating higher yields because growth was so strong.
In terms of issuance as well, I mean, the US is also, well, every economy, but we'll start with the US and see if you have any thoughts on other economies as well. I mean, the US is already running large fiscal deficits, and we've gone through a series of auctions. We've not had, I think, too undue of a reaction to that, especially given, as we've said, price action this week so far has been pretty constructive. But How are treasury auctions going in your view? What are demand patterns like? Is there anything in our flow indicators that show that just any fatigue in continuing to fund deficits, whether it's the US, Europe, or the UK?
Yeah, for sure, U.S. demand, depending on various parts of the curve, looks weaker than it historically has been. A lot of the work that we've done on the team here is to really try to take a longer view on that demand from, if you will, a relative size of a very large growing market. So, as you and most of our listeners know, we generally look at the world from a 5 year kind of look back period, and that captures a lot. But when we're talking about these structural types of concerns, sometimes it's good to go back into different analogs. Whether we look at it from the GFC, look at it from really the low yield environment in the mid 2015s or so, and kind of see where that demand is, both from a maturity perspective as well as from a buyer group perspective. And what we've noticed, particularly over the last month, is that that demand is really focused at the short end. So treasuries still play a role, but it's really notable that the demand outside of, let's say, the 5 to 7 year part of the curve drops off significantly. That's especially true for that cross-border investor, that foreign investor who, in a lot of ways, is that marginal buyer in the treasury market and ultimately is so important. That, I think, explains some of the unusual reaction that we've seen on the longer end with real yield as this conflict evolves, if you will, where there's more pressure on the long end over the last couple of weeks as expectations for this conflict, really gets repriced, if you will. And differences between price action, if we were to look at real yield in the treasury market versus potentially other G3, G5 markets, is also notable, where that concern at the long end seems to be most prevalent in the 10 to 30-year maturities for treasuries, unlike what we've seen in bunds and gilts, where break evens seem to be driving much more of that discussion, even out the long end.
There's something you picked up on in referring to credit and that's impact on the economy, and actually there's 2 aspects that I wanted to talk about, that being one of them, but also short rates and funding markets. One of the things that's really struck me about the last month is we've obviously had volatility, especially as we said at the beginning in rate markets. We're starting to see more volatility pick up last week, especially in equity markets. EM currencies are seeing it. But we have yet, and our systemic risk index is a really good guide for this. We have yet to really see this move from maybe an episodic period of volatility to something that is more systemically worrying. And I'm curious, and I want to attack it on both channels, the very, very short end, the kind of funding markets, and then we'll talk about credit. But in the very front end, do you capture any signs of significant stress that are coming in the work that you do looking at funding markets?
I'm going to say that I'm disappointed that I haven't captured much, which really sounds terrible, but does make for really interesting discussions with you for sure, but
Yeah.
with customers and clients also. The funding markets are surprisingly robust at this point. I'm during these periods of stress, I kind of go into like almost a war room mode and look at a lot of different indicators to see if that stress is either emerging in repo, kind of the overnight markets, whether CP potentially is facing some concerns with corporations doing that unsecured borrowing, looking at high yield and IG issuance, treasury spreads is an important part of that currency basis. The mosaic, because the dollar is such a widely used funding currency around the world, does give you a good sense of whether or not stresses are developing in any one of those markets. And they often start to bleed into others. And when I say disappointed, it's because things are functioning really, really well. It is amazingly calm. There certainly are signs of flare-ups in stress occasionally, but overall, funding is working pretty well. And we could look at repo spreads, we could look at the currency basis data that comes out of Bloomberg, and they're moving within fairly stable bands. It does give you comfort that there's a lot of liquidity in the system. We could think about why there's so much liquidity going into it, but it is consistent with what we've seen over the last couple of quarters.
If you had a desert island indicator of that, though, to pay attention to, what should people have on their dashboards or their Bloomberg launch pads, whatever it is? And I don't know if you want to give a ticker or anything, but kind of what is the thing where if it cracks, you will know that something more nefarious is afoot?
Yeah, I mean, so for spreads, if you will, so for to, let's say IORB reserve balances, is the cost of borrowing overnight starting to increase? That's always on the top of every dashboard. I do look at that cross currency basis, whether it's against yen or whether it's against euro, to see if we, start to widen within that because that is an efficient vehicle for dollar funding. For the most part, those are quite stable. And then just like the CP market, I'll look at CP spreads and I'll, really try to get as much color around CP issuance because that unsecured corporate borrowing is so important that if these big companies are experiencing problems in kind of raising money in what is, a fairly robust market, then, things are moving downstream pretty quickly.
Well, we've covered the front end, and it all speaks to what I look at my dashboard for corporate credit spreads, and I want to talk about public credit, but also, of course, private credit, because you and Kayla Sater, who was on a few
Yep.
weeks ago, she talked about the private credit concerns that were already swirling before this most recent crisis kicked off. But just looking at spreads, yes, high yield has widened a little bit, but you would
Yeah.
kind of expect that with rates higher and just as a function of broader market volatility being higher. Investment grade spreads have not moved at all. I mean, how would you characterize? You said you looked at issuance, and I'm be curious to start there with issuance patterns and if they've just kind of pulled back as a reflection of the environment without the attendant spread widening. I mean, why have the longer term funding markets for corporates remained so relaxed?
The bottom line is that there's liquidity available for it. I think that when we look at money market fund assets, if you will, in terms of robustness within the system, we're still seeing that money flow into the real money space. Some of those money fund assets might be slowing down a little bit, but it looks like they're making their way into the short end of the credit curve because you could take advantage of that repricing a bit more quickly. That's ultimately the bottom line. In terms of how issuance has fared over the course of the last month, it's been sporadic. I'd say that it's probably one of the indicators that I'm looking at more closely because it's not completely devoid of any of those concerns. We have had several days where there was zero issuance, followed by days where, if you will, the market calmed down and all of that issuance came to market. So the demand for that capital is still there on the corporate side of things. So it's important that they can continue to access the markets. For the most part, if we were to look at it from a week over week perspective, there is less issuance, but it's not troubling yet. And we're getting to generally a period where issuance slows down a little bit, whether it's because of the Easter holiday or April seasonally has less issuance as companies get through their corporate tax paying season. So maybe the pressure is a little bit off when it comes to that market, but the amount of credit availability is still there for the public corporate bond market. And that is to a certain degree in contrast with this private credit discussion, which really took center stage at the beginning of the year, is still swirling in the background, but certainly has not gathered as many headlines given everything else that's going on
Yeah, I was
ultimately.
gonna say, it seems like, I mean, this was the big concern in January and first part of February, so much so that we did a podcast or 2 about it, and it just seems to have gone away. Have the fundamental issues been alleviated in any way? Have they been worsened? Or is it just a matter of behavior and we're not focused on it anymore, and therefore it maybe isn't as acute a problem?
Yeah, I mean, when you kind of think about what we were concerned with, let's say in January and early February, where it was private credit and where AI was going to take away your job, my job, and everyone else's jobs, we hardly see any of that right now. I always found the AI discussion a little bit premature, but the credit side of things, certainly given how important that funding is to a lot of the growth expectations was important. Those concerns have not gone away. We've seen more gates put up in terms of the ability of investors in these private funds to take money out, but those gates ultimately are there in order to get through some of these liquidity hiccups. The way I look at it is that we do have liquidity concerns at this point, particularly when you allow what has been these private vehicles into the public market. And by that, I mean some of the BDCs that invest in these levered loans, if you will, being traded on the public markets. We've got publicly traded BDCs, and they are responding to volatility across the equity markets in a way that a lot of the other stock markets are. And the implication has been that the value of the underlying assets is much less. And there probably is some truth to that, but to take that and bleed it out into the broader private market where you could put gates on it, if this is in fact temporary, the broader data center, AI, and really private credit, because that market is not just on the technology side of things. There are a lot of other companies certainly that issue within this market. If the robustness of it remains, somewhere within the bands that were expected, and you got to remember, you're getting a very high interest rate associated with these transactions, 8, 12, 15%. They are risky investments. You do expect losses when you've got that type of interest rate associated with it. If the underwriting is still doing what it's supposed to do, it's going to be a liquidity issue rather than a credit issue. And that's kind of where I stand with it at this point. We're looking at it every day. We're going to look at it much more closely using our colleagues at MKT Media Stats to try to get a sense of what the underlying loans might look like. But for the moment, it does look like it's more liquidity at this point, which we've seen in the past. If it becomes a broad credit issue, then a lot of the growth and or sectoral issues that the market has really been concerned with does come to the top a bit more aggressively.
An interesting thought insofar as it takes me actually nicely to where I wanted to finish this, which is to think about central bank policy and especially to think about the central bank repricing. Because we've talked about this inflation now versus growth hit later, and the central bank reaction function, though, is being repriced far more aggressively in the direction of addressing the inflation questions as opposed to the growth questions. And I want this to be a broad discussion of whether that's right. But the first question I have is just thinking about G10, so developed market central bank rate pricing. We've gone with a year ahead view to pricing really no activity. You had some central banks that were going to cut a little bit, some that were going to hike a little bit, but it was all going to kind of be net zero when you added them all up against across the G10 central banks. We've now priced a cumulative, I think it's about 650 basis points across the G10 over the next year of interest rate hikes. And I don't think there's anybody that still has an easing bias, at least as far as market pricing is concerned. We've had, as a consequence of this crisis, a tightening of financial conditions, lower equities, lower bonds, et cetera. Is that pricing, we'll talk about whether it's justifiable and whether it will be delivered, but is that enough, given the point you made about the high rates private assets have? Is that enough to create that liquidity crisis, or is it just really a drop in the bucket when you consider where these guys are funding anyway?
For the moment, I don't see it creating the liquidity crisis, given the fact that, most of these central banks were at neutral. There has been, a structural change in that reaction function. And, we can get into the mandates of all the different central banks, potentially being different. Certainly the Fed with the dual mandate versus the ECB being, very, very hardcore on that 2% inflation number. You've got to acknowledge that your inflation transmission mechanism, if you will, has changed to a significant enough degree with enough uncertainty that thinking about hikes is appropriate. And if you're a single mandate central bank, that growth aspect really doesn't become a concern unless it pulls down, obviously, your inflation expectations. So, we're at kind of that uncertain plane right now with regard to how much of that inflation makes its way into growth and ultimately makes its way back into inflation. So, I don't necessarily find it incorrect to really change your view around that. Kind of having said that, we are getting to the point, especially if this is a much longer conflict than really investors and, for the most part, maybe even the politicians were expecting, that we do start to have to think about growth. So I'd say that we probably are going to chop around from an expectations perspective from this point onwards. It's been very much a higher yield trade up until now. The longer this goes on, the more of a concern that growth discussion becomes. And you're going to wind up seeing at least the short end respond much more aggressively to the two-way risk rather than the one-way risk that has really driven trading for the last 4 weeks.
Yeah, and that's why I wanted to start to put some numbers on this because you mentioned some of the inflation or the kind of single mandate central banks, the ECB. We've gone from, I think, half of a cut expected this year, so basically no cuts, to now potentially three cuts by the end of, sorry, three hikes
Three
by the end of
hikes,
this
yeah.
year. Yeah, little Freudian slip there. Yeah. The Bank of England is very, perhaps even more extreme. In fact, I think we were looking at two cuts by the end of this year, and now we're looking at 2 to 3 hikes by the end of
Yeah.
this year. And some of this, admittedly, UK rates are not very liquid in the best of times. And so there are those considerations to make, I think, around the potential overshoot in rates. But are we expecting that to be the realistic outcome here? And again, the growth concerns are going to weigh, I think, almost no matter what, even if these are inflation targeting central banks. In other words, for those two institutions in particular, do you expect that type of trajectory to be realized in terms of higher rates?
I think that's aggressive. I think that's aggressive. I think if we're talking about the inflation transmission to that degree, growth becomes a much bigger issue. It's not as if these economies are so robust that they can absorb all of this and really wind up not having the impact on growth. So to me, it does feel aggressive, and I would think about short end steepenings as a result of this.
And would you throw Canada into the mix? That was the other one I forgot because I was there last week and nobody could quite believe that the rate hikes were being priced again, just given the domestic economy looks so vulnerable. But they're another one of these single mandate central banks.
Yeah, Canada, because of the energy component within the economy, makes it probably a little bit more complicated in that they do deal with the stagflationary aspects of it. They're, for the most part, trading with U.S. rates. However, at this point in time, if we do get a bit more relief in terms of expectations for a tighter Fed going forward, I think that makes its way through into the BOC view quite quickly. And from that perspective, it's going to follow a lot of the other discussions that we had, maybe not as aggressively as the ECB and the BOE, however.
That brings us to the Fed. And we've now taken out all the easing that was priced this year. Two cuts now, basically a flat curve, not just out to the end of this year, but really out to the middle of next year. What's your expectation for the Fed? I had dinner with Lee last week and he's still very much on board with cuts, but the market is thinking differently now. And you have a Warsh Fed from the middle of this year onwards. What do you think the Fed will actually be able to do, if anything, by the end of this year?
Yeah, I mean, have me on again with discussions around the worst Fed, but
Well,
I've
you're
been
going to
fair.
do the Jackson Hole episode again for sure. So you're coming back for that.
I mean, my view has been that the Fed has not needed to cut as aggressively as before the conflict, where we were pricing in, 2 to 3 cuts, if you will. I've been in the one cut camp. I still remain in the one cut camp. There are implications that the bleed from these higher energy prices is somewhat offset by, still robust capital spend. So again, getting back to liquidity and just how circular a lot of these discussions are. But I still think that capex is an important driver within an economy that has liquidity. That liquidity would ultimately make one to believe that there's still spending that's available out there. We might be drawing into it a bit more every single month, but we're not going to see the collapse of the economy. When it comes to Fed policy and credibility and all of that discussion, I think that they're spot on for staying on hold. And I think that even when you see the changes in March projections with, Stephen Mirren, for instance, becoming less dovish this year, it's an example that there's just very little flexibility when you've got this inflation surge. And I think that that's going to make its way into the third and fourth quarter, and we still might get a cut, but I wouldn't be surprised if neutral is, just one cut away.
Would you have a broader steepening bias for the curve, though? Or would you start to think about maybe bullish flattening with such a limited amount of activity in the front end?
I mean, if I'm trading it, and really trying to time curve trades is incredibly difficult. It would seem that the growth concerns in the short term is going to steepen the curve, and I would ultimately feel comfortable playing the volatility that exists in that trade now. Longer term, I still think that you have duration overhang. Our data is really, really interesting in how demand dynamics out the long end have changed over the last several decades, quite notably. And I think that overhang with a federal government deficit that's growing, even though issuance has been somewhat stable, it's going to grow much more aggressively as we get into the second half of this year, going into next year. Just based on the timing of the receipts versus payments.
Steepening all the way down, then, is it?
Yeah, yeah, yeah. I'll stick with that.
Fair enough. Well, we'll reconvene in August. We do our annual Jackson Hole preview with you every single year. It always is a treat. And this has been an absolute pleasure to catch up with you at such a critical time in markets. I can't stress that enough. It's rate markets that really have been in focus. I think I got more questions about that than what I was presenting last week. That's for certain. People didn't
No
really
one
care
better
about
to
that.
answer them, though. No one better to answer them than you, Tim.
Yeah, but I ask the questions. That's the thing. That's the job. But for this time around, Marv, thank you so much. It's been educational as ever.
Thank you.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. State Street Bank and Trust Company, hereafter referred to as State Street, and is for informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.